Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. In the past 5 months, the S&P 500 has appreciated by 34%. That's the 5th best 5-month return in the past 75 years for the index. Today we're assessing where we stand in the stock market compared to past extreme periods. The Federal Reserve cut rates this month. At nearly 23 times forward earnings, this is the most expensive the S&P 500 has been in at least 35 years when the Fed lowers rates to try to stimulate growth. The average investor is so bullish that a new record has been set in the margin debt ratio that we track. We've shown this chart before, and we are bringing it back because a new record has been set in its 60-year history. The left chart measures how much interest is being paid by investors to take on more margin debt so they can buy even more stocks on leverage. That total is measured against the size of the economy at the time. Previous peaks were at the height of the dot-com bubble and just before the great financial crisis in 2008. Today's level eclipses both of those high marks. The big move higher in the stock market since April has been most concentrated in the stocks that are considered to be the biggest beneficiaries of the trend in artificial intelligence. The market cap weight of AI stocks as a percentage of the S&P 500 jumped from 26% in April to 34% today, a new record. Something significant happened in the AI world this month that suggests to us that we are in the next phase of this trend. And that was Oracle's earnings release. In their release, the company increased its estimate of future revenue they expect to earn from their customers by hundreds of billions of dollars. It's an amazing growth opportunity for the company, but it also means they are going to have to issue debt to finance the build-out of this AI infrastructure for their customers. That's new. Until now, the big AI spenders have been able to fund their CapEx spending with existing free cash flow. If the build-out accelerates to the point all these hyperscalers need to issue debt, the risk of building more than is needed is much greater. It's what ruined past bubbles like the railroads in the mid-1800s and the dot-com bubble in 2000. One useful way to consider how this all plays out is looking at past boom and bust cycles in the stock market. Individual stocks can double in 3 years or less. It happens all the time and doesn't automatically mean the company's share price is going to decline back to where it started. But when a whole index of stocks doubles in 3 years or less, that's not normal. That's a 25% annual growth rate, or about 3 times faster than the long-run average. When that happens, the risk of the gains being given back is a lot higher because much of the doubling in price has come from sentiment and not fundamentals. That was the case in the roaring 1920s when U.S. stocks appreciated by about 140% in 3.5 years. Investors were back to where they started 2 years later. Japan experienced a similar boom and bust in the late 1980s. Its index also appreciated by about 140% in a little over 3 years. Then 2.5 years later, the price had fully retraced its steps. Finally, there's the NASDAQ Composite in the late 1990s. A 260% return in the final 3 years of the dot-com bubble. And yet, 2.5 years later, you're back to the beginning. So what index is a greater than 100% price return in the past 3 years? The NASDAQ Composite and the NASDAQ 100. We are not predicting when these tech indices peak. Legendary investor Howard Marks thinks the current environment is similar to 1997, which would mean there are 3 more years of this kind of unprecedented growth. He might be right. All we know is when a mania is building around a transformative technology like this, the financial market participation in the trend often goes too far and sets up a multi-year decline in that index that comes later. If you've been lucky enough to participate in this huge move in tech stocks, that's fantastic. Our suggestion is start to rebalance some of those winning positions into other stock sectors and asset classes because no one knows how to perfectly time an exit from a trend like this. We hope that gives you a sense of how we're seeing the stock market heading into the final quarter of the year. If you have any questions or would like to learn more about Oxbow, please contact us. We try to provide the information we think is most relevant to today's investors. If you'd like to follow us more closely, please subscribe to our Oxbow Advisors YouTube channel.